What is original sin, and how does it relate to balance of payments crises? Have you ever wondered why some countries struggle to borrow money in their own currency? This issue is known as original sin in economics. It refers to the challenge faced by many countries, especially emerging markets, when they cannot secure loans in their domestic currency. Instead, they must rely on foreign currencies, which can lead to serious financial problems. The term original sin draws a parallel to a theological concept, suggesting a fundamental issue in international finance. Investors often prefer lending in stable currencies like the United States dollar or the euro. This preference leaves emerging economies at a disadvantage. When these countries need funds, they often end up issuing debt in foreign currencies, creating a currency mismatch. This mismatch occurs because these nations generate revenue in their local currencies but must repay loans in foreign currencies. If their domestic currency loses value, the cost of repaying that debt skyrockets in local currency terms. This situation can lead to financial instability, making it difficult for these countries to meet their external payment obligations. Now, let's connect this to balance of payments crises. A balance of payments crisis happens when a country cannot fulfill its international payment commitments. For nations that relying heavily on foreign currency debt, a depreciation of their currency can worsen their debt situation. This can trigger capital flight, where investors pull their money out, leading to a depletion of foreign reserves and pressure on the exchange rate. In the context of capitalism, original sin highlights the difficulties emerging economies face when trying to integrate into global financial markets. It reflects investors' preference for stable currencies and the risks associated with less developed financial systems. Countries with strong monetary stability and sound fiscal policies are better equipped to borrow in their own currency, reducing their vulnerability to external shocks. To address original sin, emerging market economies need to create credible monetary frameworks that promote low and stable inflation. Developing deep domestic capital markets is also essential. These steps can help countries issue debt in their local currency, which reduces the risks associated with currency mismatches and lowers the chances of experiencing balance of payments crises. In summary, original sin is a significant issue in international finance that prevents many countries from borrowing in their domestic currency. This situation increases the risk of balance of payments crises, especially when exchange rates fluctuate. By focusing on institutional and policy reforms, countries can work towards building stronger financial systems that enhance their ability to manage their debts effectively.